Okay. So this is basically the results of a working group that we set up with the help of the Bank of England. There are a number of economists from the Bank of England there. We've had support from Allen and Overy, who helped us draft a term sheet, and then we have some market participants. And the IMF has also become quite active on GDP-linked bonds recently. So some stylized facts to start. First of all, there's a lot of debt out there, mainly in advanced economies. And we know that these Rogoff thresholds have to be taken with a grain of salt. But, we still see a big increase in sovereign debt to GDP since the global financial crisis. Then there's a limited willingness to pay. I've put a quote here from Keynes, which I think summarizes it quite well. At the end of the day, I think sovereign debt sustainability is about flow. Flows is not about stocks. And once the flow of interest payments over GDP, or the flow of interest payments over tax revenues, as you pointed out, Joshua, earlier, exceeds a certain threshold, it becomes politically unpalatable to continue to service the debt, and then you get a default. So we have a lot of debt, and the willingness to service that debt is limited. There are political limitations to that debt service. Third stylized fact is, this is actually a little empirical study on that. So what I've done here is I've taken some numbers from Moody's for 110 countries over 15 years. And it turns out that they tend to remain solvent and pay their debt when the debt servicing falls between 0 and 5% of GDP. And when it exceeds that, you have a very small population of countries, Jamaica, Lebanon, Iceland, and Greece. And they all became defaulters. So the problem seems to be not so much debt to GDP, but debt service over GDP. You can have 200% debt to GDP, as somebody said earlier today in the case of Japan, as long as the debt servicing is low. That's okay. Shaheen mentioned that earlier today. As long as the debt servicing is low, they're fine. But once the debt servicing exceeds a certain threshold of tax receipts or GDP, then you get a default. The fourth stylized fact is we spoke earlier today about the debt reversal after the Second World War in advanced economies, which basically occurred because we had very high levels of nominal GDP growth, and that allowed countries such as the UK to bring down debt relative to GDP and debt servicing relative to GDP. But that seems unlikely in the future, mainly because it's very difficult these days to generate a lot of inflation. To bring the debt down. So I've categorized here four types of countries. We have the emerging market countries with original sin. They are able to generate inflation, as in the case of Argentina, but unfortunately the debt is in dollars, so it doesn't help. Inflation doesn't bring down the debt. Then we have the member states of the euro area. Well, they issue debt in a currency which is not their own currency, which they cannot print. And they don't have inflation either, so for them inflation doesn't work. Then we have countries such as Sweden or the UK, which in theory could use inflation to get rid of their debt, but they cannot generate inflation. So the only group of countries that can actually engineer a debt reversal, if they can generate unanticipated inflation and have long-term maturities on their debt, are some of the emerging market countries such as Brazil and South Africa. But for most countries in the world, debt reversal via inflation and high nominal GDP growth is really not feasible. And then the last point on the stylized fact I'd like to make comes from an intervention by Christopher Sims, where he basically argues that a lot of people say that when you have too much debt, you can either inflate or you can default, and it doesn't matter because in both cases you lower the real value of the claim. But that's actually wrong because defaults, breaches of contracts, are extremely costly for output, and they're discrete events, and they expose investors to a great level of uncertainty, and that is then reflected in high levels of risk premia. So defaults are really very costly, while sort of inflating your debt away via inflation is more of a continuous process, not discrete, and that doesn't lead to such big costs. So defaults are costly. So all of this, I think leads us to a very difficult situation. Elevated public debt levels, debt reversal is implausible where we stand today. And in advanced economies, at least, we're dealing with a lot of financial repression. So the sovereign debt in the European context, for example, is really only kept affordable as the central banks are suppressing interest rates and are keeping the debt servicing at a low level, although the debt as such is already quite high. And we have very little fiscal space. So imagine a country such as Italy or Portugal facing another banking sector crisis. They're basically screwed. I mean, they're going to lose market access very soon. So it's very dangerous at this threshold. Or imagine another shock to output. You get a 10-20% decline in output, and that's just very difficult with this level of debt. So we have a risk of outright payment default, and that risk of outright payment default leads to sudden stops of capital flows, to nonlinear changes in yields, and to the financial fragility that Jean-Pierre spoke about earlier today. So that's the problem that we have with sovereign debt. And now I'm trying to convince you that Volcker was wrong in saying that there has only been one financial innovation over the last decades which was worth it, which was the intervention of ATMs. There is at least one other financial innovation which can make sense, and that's GDP-linked bonds, which are going to save the day. So GDP-linked bonds, how does it work? You have a certain portion of your national nominal expenditures that you earmark for sovereign debt service. As Keynes pointed out, that can be something like 5% of GDP. And if your output or your tax revenues fluctuate with the economic cycle, then every once in a while, the budget that is available for the debt service falls below that threshold, and then you get a default. Yeah, that's very unfortunate. And one way to avoid that would really be to align the debt servicing costs of the sovereign with its payment capacity by issuing debt that is indexed to GDP, both the coupon payments and the maturity payments. And then you get what Michael Pettis has called a correlated capital structure, which is on the right-hand side here, where basically the payment capacity is indexed to your payment streams, and you never really default. When you run into a crisis, you pay less, because your debt is indexed to GDP. And when things are going well, then you end up paying more, your coupon goes up, and your repayment also goes up. So that's the idea behind GDP-linked debt. You design state contingent claims that basically render sovereign defaults unnecessary. So this has been discussed for decades. Robert Shiller started that with the book Macro Markets in 2003. There has been an IMF working paper in 2010 by Paulo Mauro and Eduardo Borenstein, and all sorts of academic. I mean, Mark told me that there was a meeting in 2009 of the Reinventing Bretton Woods Committee in Turkey, where this has already been discussed. So the idea of GDP-linked debt has been circulating in academic circles for decades without anything ever happening. And what we're trying to do with our little working group is actually to get people to print paper. So the idea is to develop a standard term sheet that can be employed in the same way that the Canadian term sheet became the standard for inflation-linked debt. That can be employed by a number of sovereigns to issue GDP-linked bonds. A very nice term sheet that we drafted together with lawyers from Allen and Overy, which can really be put to work under UK law. So the Bank of England has helped in that respect. There was a workshop there in November last year. You can find the documents on the internet. There is the London term sheet, which we drafted, and also a summary of the work that has been done. So how are we designing those instruments? The key point is to move away from GDP warrants. There are lots of GDP warrants out there, for example, value recovery rights in the case of Mexico and Venezuela. We have GDP-linked bonds in Bosnia-Herzegovina. We have GDP warrants in the case of Bulgaria. We have in Nigeria oil warrants. So there are all sorts of GDP warrants out there. And they're all very bespoke instruments. We have in Argentina, we have GDP warrants. We have GDP warrants in Greece. Most of those instruments are actually all of these warrants have been issued in the context of sovereign debt restructurings. And this explains the extremely funky cash flow structures that we find. For example, in the case of Argentina, they negotiated a haircut of 42% of the original claim in the 2005 sovereign debt restructuring. And then those who participated in the debt restructuring got a GDP warrant, which gave them upside of 42 cents, so total payment capacity of 42 cents in the best of all worlds, which would allow them to actually fully recover what they had lost. And then you get these extremely funky cash flow structures, which are asymmetric, which are bespoke for each sovereign, and which lead to very complicated dealing in the secondary market and very high risk premium. I mean, we've been trading that stuff at Spinnaker Capital for years, and you can make a lot of money by trading GDP warrants, but it's basically because it's a very sort of specialist market with very high risk premia, very little liquidity, and we want to move away from all that stuff and move towards symmetrical instruments, which give you not only upside but also downside when the economy turns sour for the sovereign. Plain vanilla instruments instead of bespoke instruments. And also we want to move away from a stream of annuities to bonds which have a principal which can be used as a store of value. So that's basically moving from gone concern, from instruments that are issued in the context of a sovereign debt restructuring, to going concern, to instruments that can be issued in the primary market, on a regular basis. So this is how the instruments are supposed to look like. We're going to index both the principal and the coupon to nominal GDP, and we issued the paper in local currency. And then in the London term sheet, which you find on the internet, we have all sorts of nice bells and whistles in the term sheet. For example, we have a pari passu clause, which introduces a level of seniority over the plain vanilla instruments. So this is basically becomes a class of instruments which are only pari passu among themselves and not with the rest of the nominal debt that the sovereign issues. So if the sovereign wants to default, it can default on its old debt and at the same time remain current on the GDP-linked bonds, because they basically have an embedded debt restructuring in them. Let's imagine a country such as Greece has a 25% drop in nominal GDP. If it has GDP-linked bonds, then the stock of those bonds declines, the nominal value declines by 25%, so you actually don't have to restructure them. And then it will also have nominal bonds, and will have to restructure those nominal bonds, but it can keep the GDP-linked bonds untouched. All of that is detailed in the term sheet, so lots of nice little bells and whistles to give payment protection, to deal with GDP revisions, fallback options on the calculation, and so forth. Why introduce bullet repayments? The GDP warrants that we have in the market today are streams of annuities, but we need an instrument that actually can be used as a store of value for pension funds and insurance companies. I mean, in the previous presentation we were saying the big difference between those GDP warrants and GDP-linked bonds is like the difference between a Segway and a cell phone. So a Segway is a beautiful, Segways, these little things where you can stand on. It's a beautiful idea. Unfortunately, it doesn't fit any ecosystem, any transportation ecosystem. There are no roads. You don't know how to drive on them. You can fall over. So this is why this intervention never took off. It remained alien to the transportation ecosystem, and this is why GDP warrants also never took off. On the other hand, GDP-linked bonds, I think, can become like cell phones. I mean, when cell phones were invented, everybody knew what a cell phone was because everybody knew what a telephone was, and people can relate to that. So when you're a pension fund, you need a bond which has a maturity, which has a redemption value at maturity, in order to have a store of value. And GDP-linked warrants have not been able to provide that, while the bonds do provide that store of value. Why do we link the principal to GDP? It's basically to generate an equity-like return for investors, and also for the sovereigns. We want to give them downside protection. If we only index the coupon payments, you don't get enough downside protection if you have a shock to output. So this is how it would look like. I've got here a French bond. Since we have a lot of French people here, I took a French bond. This is an existing bond that the Agence France Trésor taps on a regular basis. It's a 2.75% due 2027. So that is, when France issues their bonds, they tap those bonds on a regular basis. This happens to be a bond which has a coupon of 2.7%. And the market yield today is around 29 basis points. So when they issue that bond in the form of a tap, they're going to sell it at a price of 129. So that's just a plain vanilla bond. The Treasury goes out, issues a 2.75% bond, and collects 129% of face in that issuance. Now, the Agence France Trésor also issues inflation-linked bonds. And those inflation-linked bonds, here we have a 2027 inflation-linked bond, they carry a real coupon plus inflation. So they're going to issue that bond as well. They do a tap. And what they tend to do is they issue that at a market yield which is slightly higher than the yield for the fixed-rate bonds. So you see the fixed-rate bonds, they trade at 29 basis points. And when they tap the market for the inflation-linked bonds, they have to pay 2 basis points of spread. So it comes at a slightly higher yield. And then you get 140 cents, an issue price of 140 in that example. So imagine we get a GDP-linked bond, a 2027 GDP-linked bond that the Agence France Trésor issues in the market. In this case, it would be a bond that has an interest of 1%, and the interest is indexed to GDP. I've plotted here what happens to the interest payments in the case of a nominal trend growth of 3%. You see the coupon goes up all the time. And then the principal also goes up all the time. So this is basically the projected stream of cash flows. And if you discount that at a market yield which is 10 basis points higher than what you get for the fixed rate bonds, you get a price of 150. So that's basically how a GDP-linked bond would look like. It would work very similar to an inflation-linked bond with the coupon and the redemption payment linked to nominal GDP instead of being linked to inflation. And then you issue the bond in the market, you pay a slight premium, that's your insurance premium, and then in this case you get an issue price of 150. Now, the problem, just a little technical note here, the problem with issue prices of 150 is that a lot of people don't like to pay 150. So we introduced a little gimmick in our term sheet, which is the principal factor. So we just, we can design those bonds in a way that the redemption is actually 0.65% or whatever you want to choose of the notional value, and that allows you to issue the bond at par. So that would basically be the payment stream of a GDP-linked bond with a principal factor, still discounted at 41 basis points, which is a spread of 10 basis points over the red card, no? Yeah. So 2-3 more bonds. So we can talk about how to determine the risk premium theta here. That's a big question. And just some words on what these GDP-linked bonds do. So these are fan charts that the Bank of England has developed. And you can see here basically the 99th percentile. You do a Monte Carlo simulation where you very, very, very nominal GDP growth, inflation, and you vary interest rates and so forth. And you vary a little bit the primary balance. And you can see that if you're a country that has a starting point of 100% debt to GDP and you have all of your debt in conventional bonds, then you have a chance of ending up at 160% debt to GDP, even if you run a small primary surplus and you have very low levels of nominal interest rates as you have them today. When you move from from conventional debt to GDP-linked bonds, you reduce the variability of your sovereign debt to GDP trajectory tremendously. So that's the big advantage. You basically eliminate tail risk. You eliminate the tail risk of defaulting. That's the whole point of those GDP-linked bonds. And that actually also holds when you have a risk premium of 100 basis points over the conventional bonds. To summarize, I think the GDP-linked bonds allow sovereign issuers to purchase insurance against economic downturn, loss of market access, and thereby prevent the necessity of sovereign defaults. I think they can also be an instrument for corporate issuers, for example, for issuers that are, domestic cyclicals. If you're like a Nestle, would be not much better to issue GDP-linked bonds than issuing fixed-rate bonds. For investors in advanced economies, put yourself in the shoes of a pension fund or an insurance company. You're basically facing slow death. All across Europe, the insurance companies and the pension funds are all going to go bankrupt in the next 10 years if the ECB keeps their zero interest rate policy. There is a tremendous amount of financial stability risk which has been introduced by the zero interest rate policy of the ECB. They're all going to go bankrupt with this level of nominal interest rates. So when you offer those in long-term investors GDP-linked bonds, at least you give them a chance to have some high nominal GDP growth and to avoid bankruptcy. So I think it would be really a good thing for pension funds and insurance companies in advanced economies, and it would thereby also help to reduce contingent liabilities for the sovereigns. And for central banks, finally, put yourself in the shoes of the ECB. I think it's impossible for the ECB to raise interest rates today. I mean, it's, you know, the entire system is hooked on those low rates, and you've got massive fiscal dominance. So if you move to GDP-linked bonds, at least you have a chance at one point in time to increase interest rates if you're facing inflation. So that would be the idea here behind the GDP-linked bonds. And that is our roadmap. We've been presenting that at a conference in London in November and at the IMF spring meetings. And we hope to get industry endorsements from ICMA, from the IIF, and from EMTA over the course of the summer. And then we hope to be able to present something at the IMF fall meetings. Thank you.
Thank you, Christian.
Pablo?